Okay, welcome. Good morning, good afternoon, depending where you are in the world. Welcome to today's session. We're excited to have you join us for the next 50 minutes or so. And let's dive right in. My name is Rich Serpa, and I head Partner and Strategic Alliance Relationships here at Jiko. Jiko is the banking model that removes traditional bank balance risk, paired with a platform that provides T-bill-backed operational accounts, allowing institutional clients to store funds while earning full yield, 24/7 settlement, and real-time liquidity without any redemption gates. And I'll be moderating today's amazing panel. Let me just forward here. Sorry about that. Here we go. Okay, so before we get started with the speaker introductions, just some housekeeping items. If you run into any technical issues, please use the chat functionality and our event producers will be happy to help you. If you have any questions for the speaker panel, and we do encourage you to participate, please submit those through the Q&A box. We've baked in about 10 minutes or so at the end for answers to the questions. If we don't get to them all live, we'll follow this up through email after the session. And as attendees of today's full session, you'll receive one CTP credit from AFP. The attendance confirmation letter will be emailed to you within 48 hours of today's session. And now let's meet today's presenters. So excited to introduce, just let's go around the room as I see you here, and we'll have you introduce yourself, about your role, a little bit about your company, and we'll start with my former colleague at Kariba, Cyril.
Thank you, Rich. I'm Cyril Houdard. I lead the business value advisory practice for EMEA at Kariba. We work with large multinationals to help them optimize their treasury operations, from cash visibility and forecasting to payment infrastructure. I'm based in Europe, which gives me a front row seat to how treasury teams outside the US are navigating many of the same challenges we'll be discussing today. Furthermore, I'm an active member of several professional treasury associations across France, Belgium, Luxembourg, and Germany. And thank you for having me.
Thank you. Joseph, please.
Well, and thank you, Rich. So my name is Joseph Bertrand. I'm the Senior Director of Research at Noi Group. And at Noi Group, what we do is bring leaders across the office of the CFO together, including treasurers, heads of FP&A, chief audit executives, and so on. And our members are from some of the leading companies around the world and some of the future leaders around the world. My role at Noi Group is to identify trends emerging across our member network and connect members with peers who've already tackled similar issues. We're really focused on helping practitioners develop practical approaches and turn insights into outcomes. And that's one of the reasons why this topic was extremely interesting to me and why I'm really happy to be here today. Cash investments, liquidity, capital efficiency, these are topics that always come up. So great to be here.
Yeah, super happy to have you. And finally, Caitlin, please.
Yeah, absolutely. I'm Caitlin Mongeluzzo. I head up the BlackRock Cash Matrix product and platform. We are a global team, but I'm based in Philadelphia. We deliver cash and money fund investing technology to investors and our various partners. And I'm really happy to be here today with the panel.
Awesome, awesome, awesome. Okay, so let's just take a look at the agenda. We're going to be using data from Jiko's annual corporate cash confidence survey to guide parts of today's discussion. And we're really looking forward to our panelists and providing their insights on the data collected from you and your peers. Excuse me. Today's topics will span through concerns and influences on cash strategies, cash management priorities for the balance of this year, real-time settlement, and a reminder again, we ask you to please submit your questions via the chat throughout the discussion today. A quick note on sort of the survey methodology, since we'll be using this data to guide most of the discussion. This is our annual survey run by Jiko to capture how Treasury and finance leaders are thinking about cash management, risk, liquidity, and settlement while optimizing their strategies for the year ahead. The data we'll be looking at today was collected from April to June of this year. Just under 200 Treasury finance leaders were surveyed both online and in person. We did those at the various conferences we attended in the spring. One thing to keep in mind, respondents did skew towards the larger US-based organizations, so there's a full survey report with the findings that will be sent out again after the webinar concludes. To kick things off, I'll just make sure I'm captioning it. Okay, to kick things off, the survey asked, if there's any concern around, geopolitical tensions affecting cash strategy. So about 2/3 of the respondents addressed concern. Joseph, I'll go to you first. Could you uncover the impact of geopolitical conflicts at a macro level?
Absolutely. And I should preface this by saying I studied economics in my undergrad, but I'm not an economist, but I'm going to try to do my best to give a bit of the macro picture and then through the lens of practitioners. And yeah, absolutely, Rich. I think the first thing that stands out is that the anxiety is real. The 60% saying that they're concerned about geopolitical tensions. We're hearing that also. And really what our members are talking about, and I think top of mind for everyone is a conflict in Iran. We were expecting that to be a short conflict, but it's moved into several months at this point without a clear end in sight. And, as we know, that creates uncertainty around energy prices, which have downstream effects, impacting inflation and interest rates, which we'll talk a little bit about later. Um, what makes the environment challenging and also interesting is that other factors remain positive. So it looks like the economy is still fairly resilient. So this isn't, treasurers aren't really in a crisis mode. They're really thinking about how do I prepare for uncertainty? And then this kind of impacts, inflation, as we mentioned. Fed expectations shifting is a big factor. And then FX volatility makes forecasting more difficult. So, overall, what we're hearing is that treasury teams are operating in a mixed signal environment. Um, what as risk managers, treasurers don't always mind bad news, but what really bothers them is uncertainty. So
Yeah, cool. Um, so how are these changes in macro expectations impacting treasury and finance teams?
Yeah. Yeah, let me take this one, Rich, because this is a real question. Because the areas Joseph just described don't just stay macro, they land very concretely on the treasury desk. When you have inflation persistently above target and rate expectations shifting, treasury teams have two immediate problems, let's say. First, the operating cash. Operating cash needs become harder to size. Buffers go up because no one wants to be caught short on a payment at the wrong moment, for instance. We see this constantly with clients in Europe, where you have the added layer of multi-currency exposure and central bank policies diverging from the Fed.
Sure.
Second, it becomes genuinely harder to make allocation decisions. Do you lock in yield now? Do you stay short? What if rates reverse? The result is often paralysis. Cash sitting idle at the bottom of the stack, earning nothing because the yield curve is simply too unpredictable to commit. And on the funding side, on the latest point we have here, for companies that borrow to fund operations, higher rates mean tighter covenants and less favorable terms, which pushes them to self-insure, let's say, by holding more liquid cash rather than relying on their credit lines.
Yeah,
Really.
that's great point. Okay, in addition to the concerns of over geopolitical tensions, we also asked what the primary factors influencing cash strategies were. Over half the respondents indicated it was interest rate risk. So, Joseph, going back to you, could you touch on what the current environment looks like and how exactly does that rate influence cash strategies?
yeah, absolutely. I think what we're seeing in the survey resonates with what we're hearing in conversations. And, we were at Noy Group lucky enough to share this survey with our members, so we got insights from them as well. I mean, what's interesting with, potentially higher interest rates is that many companies have already adjusted for a high interest rate environment. So, higher for longer seems to be the built-in expectation. Um, Even though I would say at the beginning of the year, in our conversations, people were expecting rates to remain flat or maybe even decrease. But we're seeing today that that is likely to change. Looking at the second bullet here, I would say this is where the real challenge is. And in our discussions, we're hearing that forecasting interest income is a focal point, and it's ultimately about how much cash will actually be invested and where. One of the treasurers I spoke to mentioned that thinking about buybacks or an acquisition or a shift in working capital can change balances, and then that can impact expected interest income. And then another thing worth noting is that, the benchmarks have been a little bit complicated. If you look at the SOFR, at times being above the Fed funds rate, which creates challenges around conversations with the CFO and others within the organization. And then the last thing here that stands out to me before I pass it on is that teams that are navigating uncertainty most effectively, they're not focused solely on where rates are going. They're building in flexibility into their strategy. They're running conservative scenarios, and then if there's an upside, then that's a bonus, right? The common theme is around optionality and being able to adapt to different conditions.
Yeah, good stuff. Thanks, Joseph. The second most selected factor was banking sector stability. So, we're a little bit past 3 years removed from the last major banking crisis with SVB and First Republic. Caitlin, why do you think this was one of the top influences on cash strategy? Like, is this just residual concern?
Yeah, I do think it is residual concern, but it is born out of memory and historical influence that really has changed the treasury behavior and the strategy considerations of investors. You think back, you mentioned the 2023 regional bank stresses, even the GFC of 0708 is not far enough away for most investors to forget. And looking even farther back, we did have investors who probably remember the regional banking crisis and saving and loan crisis of the 80s. So as Joseph said, the interest rates and those impacts on banks and investors, it's all intertwined. So it really doesn't surprise me to see this as the second out of the 5 or 6 options. Investors are looking for opportunity, but they remember the risks associated in the banking segment over the years. And again, as I said, that's sort of a structural behavioral change. We see increased scrutiny on that deposit concentration, the counterparty exposure. We're seeing ongoing diversification across different banks, the instruments used, and the custody models in particular. What we hear is that Treasury teams are much more risk aware and proactive. It's not a reactive situation anymore. Really, the diversification of liquidity, it's now the standing policy. It's not triggered by the stress events. So it's not just something that comes up periodically. It's now been ingrained. It wasn't just a temporary shock. I think, again, it's fundamentally changed how investors think about liquidity, counterparty exposure. Asset quality is only part of that story. Thinking about funding stability, the duration risk, concentration exposure, that's really equally important. And coming into concentration hiding in plain sight, a lot of organizations might think they're diversified because they're using multiple banks. But in reality, you have to look, and concentration can exist in common custodians, clearing agents, funding sources, or industry exposures. A treasury policy might not, it might limit to a single bank exposure while unintentionally concentrating risk through shared operational infrastructure. And really, lastly, yield, it's not the only trade-off here. That classic framework described as liquidity, safety, yield, recent events have elevated safety and liquidity right back to the top of that hierarchy. And the true cost of cash here isn't just what you earn, it's understanding the risks you're being paid to take, including the risk of banking instability.
Yeah, great points, and a really good segue. So now that we have a sense of what's top of mind for treasurers in regards to cash strategy, the question now is, how are treasurers responding specifically, what is being prioritized? So given the level of concerns, it's not surprising to see that the access to cash when needed is the primary consideration. And that typically means, or has meant, increasing your cash buffer held in operating accounts at your bank to ensure payments are made or can be made and obligations can be met without delay. Especially when banking sector stability being the second most influencing factor that we looked at in the previous slide. So here are just a few considerations to just consider for all these different scenarios. And one is, and I'm going to sort of cover on the right side here. Number one, as you mentioned, there doesn't have to be a bank failure per se for access to be disrupted. So the intermediaries that Caitlin was just talking about, like a clearing bank or a wire room, between your cash and destination, can and also does face operational issues and trapped cash, right? Two, in the event of a bank failure, which is rare but does happen and can have large effects like SVB, FTC is only covering up to 250,000. And I say rare, but it's probably worth noting. I don't even know if it's right to categorize these as black swan events because we've had four bank failures this year alone. We've had two this month, and one we just had last week. It was Kentland Federal Savings and Loans Association. So sounds like a problem. You tell me. But we've seen the FDIC step in and resolve these bank issues. But there's really no guarantee on the timing of that resolution. So even if you end up being covered, it could take several days, if not weeks, and payment obligations don't pause during that time. And then lastly, in the event of this kind of failure, it's not uncommon for there to be sort of a snowball or a contagion effect that spreads to other financial institutions. So even if you don't have direct exposure to that bank with issues, you still might be impacted. Caitlin, do any of the considerations come to mind that we haven't touched already?
Yeah, I think a big one is the investment policy. The one that investors are using, it has to be flexible. It has to consider the varying needs of cash over time. Cash segmentation continues to be a really important consideration, and that has to be captured in the policy, but with enough flexibility for market situations, interest rate scenarios, and operational considerations. So investors think about things like, do you have too much concentration risk? Do you have enough investment options to deploy as your cash needs change over time? And what are you thinking about with respect to the transparency you need for the investment products that you're choosing? How are you governing those investment types that you have in your policy? And what analysis do you prepare to look into those? I will say we still see a huge demand for reporting and transparency to the underlying holdings of money funds since the GFC. Shockingly, again, almost 20 years later, it again proves the earlier point about memories are long and history shows us, plan for the worst.
Yeah. Yeah.
And if I may,
Sure,
Rich,
please.
one thing I would add is that, concentration risk concern it isn't just about the bank failure, I would say, but it's also about the settlement infrastructure in between, wire room outages, correspondent banking delays as well. There are everyday friction points that can trap cash, even if the bank itself is perfectly healthy. Diversification of banking relationship helps, but so does having visibility into exactly where cash is and where it moves. Yeah.
Yeah, excellent points. All right, so that brings us to the first polling question, and I'll read it here. The question is, what is your primary tactic for mitigating bank concentration risk for your operating cash today? And the choices are: one, multi-bank relationships, spreading deposits across multiple large banking partners; two, insured cash sweeps or ICS networks to keep funds under the FDIC limit; three, sweeping cash into liquid short-term investments, money market funds or T-bills, for example; four, no active diversification strategy for those prioritizing other aspects of their cash strategy; and lastly, other, if you have a different strategy not listed. So let's just give that a second, and once we have a majority, we'll post those results. Here we go. Okay. Interesting.
It's quite surprising. I mean, not completely surprising, let's say, or if I may, Rich, because I would expect that sweeping cash into liquid short-term instruments would rank first, because what we see consistently with clients is that T-bills, money market funds have become the default answer for concentration risk. But I would let Kathleen probably to add something after. But because it solves two problems at once. You move cash off the bank balance sheet, and you still earn yield. The multi-bank approach is complementary, of course, but it adds operational complexity without necessarily improving the return. So for large organizations, the sweep to instruments model tends to win, But I mean, Kathleen, yeah, probably you want to say also
Yeah.
something. Yeah.
No, I think again, I'm surprised as well that that came in second out of the poll. Again, we in the money fund space are seeing, near record highs in the industry. So, it serves to prove that it is being used. I think on the highest ranking answer with that relationships with multiple banks, I think again, I would challenge folks to think about that diversification. Is it really diversified on the operational side, where some of that trapped cash can happen between frictions of the custodial relationships, the operational and underlying investments being used. So, yeah, I think a similar reaction, Cyril, to the polling here.
Yeah, yeah, definitely. Okay. Yeah, we're good. Yeah. So shifting the focus to the next consideration, which is protecting principal and minimizing risk exposure and focusing on how sort of cash is allocated. Kay, let's just stay with you. How do you see clients allocating excess or even operating cash for that matter with these priorities in mind? And what are some of the key considerations you would mention to these clients?
Yeah, I mean, Cyril said it as well. We see in the money fund space a continued large allocation investors are making, and in particular to the government money fund space. And really, government money funds don't completely eliminate counterparty exposure, they transform and diversify it. Instead of taking that concentrated exposure to a single bank balance sheet, you're gaining exposure to US government obligations, collateralized repo. So it really does substantially reduce, but doesn't completely eliminate the counterparty risk. As I said, money funds are at all-time highs in the U.S. money fund assets. They've stood recently right around 7.9 trillion. For the government money funds, accounting for that, it's about 6.5 trillion, so almost 80%. Now that's a U.S. Regional look, but if you extrapolate that globally, the statistics do generally stand. A much higher allocation to the government funds is based on that implicit comfort, the trust in those assets, and the underlying securities making them up. So, the government money fund space really has evolved from being just an investment product to being more of the market infrastructure used for cash management, liquidity management, balance sheet efficiency. Coming back to that structure and the underlying holdings that we spoke of, even to the polling question, how are investors mitigating that bank concentration risk? They're using these types of products. That was the sort of second answer there.
Mm-hmm.
The redemption and liquidity mechanics really do depend on the tools being used. So think about, are you investing and accessing through a portal, through a bank, or is it both? Are you using multiple platforms? Are you accessing direct securities or accessing more into the money fund space? And then what are the company needs and how do you gain confidence in those for short, medium, long term? That concept of cash segmentation, it's still paramount, and that gets you where liquidity need and duration, they have to match up or investors will be in a bad spot. So I think it's generally easier for folks to keep it more liquid at the expense of yield.
Yeah, that makes a lot of sense. I wonder, does the order of priorities surprise you? Specifically, I'm looking at that, maximizing yield being the lowest priority.
Mm.
Why do you suppose that is?
Yeah. Yeah, please. No, maybe I
Who-
have just
Whoever,
a
jump in.
comment,
Yeah.
a comment, Rich. Yeah. Actually, it reminds me a sentence that remember the sentence, and I found that it was from Will Rogers. It's not from me. It's return on of the cash instead of return on the cash, and I found that Will Rogers is one of the most beloved and influential American public figures of the earlier 20th century, saying, I'm not so much concerned with the return on my money as I am with the return of my money, which explains a bit why we have such result, probably.
Yeah,
Yeah.
and I think yield in a vacuum, it's really not something investors can grapple with. They really do have to think about access to cash, protecting principal first. So those first two answers going hand in hand and complementing each other. Really having access to the cash means you've protected your principal and minimized the risk
Mm.
exposure. And I second what Cyril's anecdote there
Mm.
about
Yeah. Yeah.
getting the money back.
Yeah. That's really
Mhm.
great stuff. Great stuff. Okay, so this was a really interesting data point that surfaced. Typically prioritizing safety comes with a trade-off or compromise, right? And when respondents were asked how much of their cash remains uninvested at any given time, nearly half have over 10% of their total balances sitting idle, and 23% of respondents have over a quarter or more of that cash uninvested. So, given, like we said earlier in the hour, that the respondents are skewing towards larger organizations, that's a lot of opportunity cost and yield left on the table. So, Joseph or Cyril, do these numbers seem high based on your experiences, and what do you think contributes to this?
Yeah, I'll jump in here. No, I mean, I think this makes sense and it kind of aligns with what we're hearing. I mean, I think the idle cash is often a reflection of uncertainty, and I think we've talked about that a little bit. So, when forecast confidence declines, practitioners are more hesitant to invest, right? And, to Cyril and Caitlin's point earlier, it's always about liquidity and protecting the principal. At the end of the day, they're trying to mitigate risk. But on the other side of it, I think the companies that are more comfortable with investing more of their cash, they have, more confidence, but also more discipline around their forecasting. And Cyril, I'm sorry if I jumped ahead of you there.
No, I completely agree with you. And what we see on the market, I mean, there's a kind of rule of thumb in Treasury. We see that if your cash flow forecast confidence is below 95%, meaning that you have 5% of variance, let's say, between the forecast and the actuals, it means that you hold larger reserves to compensate for certainty. And most large organizations are well below that threshold, actually. So especially when they are consolidating data from multiple ERP, multiple banks, multiple subsidiaries, the idle cash isn't always a strategic choice. It's just often a symptom of not knowing precisely how much is truly investable at any given moment. Yeah, so I completely align with you.
Yeah,
Absolutely.
yeah, great, good stuff. Caitlin, how much does the time delay between liquidating and making a payment contribute to such a high volume of uninvested cash?
Yeah, I think it's a really important influence to consider. In the money fund space, what we see is a lot of clients adopting a feature called auto settlement. And that's a method of instructing the funding of a money fund purchase via Swift messaging. It eliminates a double step where you have to manually fund the purchase. We see the adoption of that through portals and also the integration with the TMSs and OMS ERPs to accelerate that settlement cycle. So I think investors have recognized that time delay is important and they're finding ways to solve for it with what they have available now.
Cool. Okay. All right. Let's see what the audience thinks, and we'll run our second poll. So, again, I'll read the question. What do you believe is the primary reason for companies holding a significant portion of cash uninvested? And your choices are uncertainty around when cash will be needed, and as a result, erring on the side of caution with an increased cash buffer. 2, a visibility issue where teams are able to correctly identify investable cash. 3, investment policies that are too stringent. 4, lack of suitable instruments. Does keeping funds at the bank fit the needs of the treasury teams? And lastly, is it operationally too burdensome to optimize for yield? So let's again give that a second for people to come in, and then we can opine. Okay, they're still coming in. All right. Okay.
Interesting. I mean,
Yeah, for sure.
if I may, maybe both of the top answers are really two sides of the same problem, in my opinion. Uncertainty around when cash will be needed leads team to hold larger buffers as a precaution, and that's a risk management response. And limited visibility into truly investable cash means that even when teams want to push cash to work, they can't confidently identify what's actually available. In practice, what we see with clients is that these two reinforce each other. Poor forecasting visibility creates uncertainty, and uncertainty justifies keeping more cash idle. Solving one without the other only gets you halfway, in my opinion.
Yeah, and I think if you go even further with that, the next step is taking action. So it's not surprising to see that operational complexity of moving funds being sort of the next highest there. You know, the human element is probably at play here. A friction is a barrier to action. So it's easier to let something sit. There's a path of least resistance. But managing investments across multiple accounts, policies, counterparties, liquidity needs, that can really create significant administrative and governance burdens, making it simpler and theoretically less risky to just keep it in deposits or something more simple or uninvested. But I think, Cyril, your point on the uncertainty and the limited visibility almost compound each other to then lack action because of the operational complexity.
Yeah. Yeah. Okay, great. Let's segue over to real-time settlement, right? So being able to operate around the clock is increasingly important, right? Though historically Treasury operations have not been able to support liquidity outside of the normal banking hours, right? So the survey asked participants whether real-time settlement 24/7 was important to their organization, and over a third said it's important. But interestingly, only 19% stated that they're currently able to do so. So let's take a look at what's causing that gap. But before that, what do you think are some of the primary use cases for 24/7 real-time settlement? And anyone, please just jump in.
Yeah, if I may, a few cases, stand out. The most immediate for me is time sensitive, of course, funding events. For instance, we have margin calls, acquisition closings, emergency supplier payments as well. When timing is critical and cutoff windows don't accommodate having 24/7 capability, changes the risk profile entirely. The second point is really about the global treasury operations. When you have entities across Asia, Europe, and the Americas, there is no universal business hour, let's say. Intraday liquidity management across time zones require the ability to move cash outside any single region's banking window. And third, as capital markets increasingly operate around the clock with digital assets, but we will touch on this probably, this mismatch between the 24/7 market and the 9 to 5, let's say, settlement infrastructure that we have today.
And I have one maybe anecdote to share. It's a brief one, but you
Sure.
hear corporate treasury teams are preparing for a potential acquisition, wonder, being questioned why they parked several $billions in something like a government money fund, why not something with a higher yield? And the answer is, well, if you call at 5 o'clock on a Friday and that's a local time, you need the cash Monday morning, you need to know it's there. So I think that's really highlighting the need for access right away.
Yeah, yeah. Joseph, do you see the same disparity in conversations with the Noi Group members?
Yeah, so I do see it a rise, but it's interesting. I mentioned earlier that we shared this survey with some of our Noi group members, and there was kind of a bit of a disconnect between how that cohort responded versus the overall. Um, Interestingly, 24/7 settlement didn't surface as a major area of focus. And then, we did some digging through our notes and conversations with members, and it hasn't surfaced directly as a topic, but I would say that it does come up indirectly. The demand shows up when we think about, moving cash efficiently across entities and jurisdictions, cross-border payments, repatriation, and so on. And these are all closely related to the broader conversation around real-time settlement. Um, but yeah, so that was one thing that struck me about this data point, and it just kind of goes to show that there's not every organization is operating the same. Everyone's kind of operating with with different things in mind. But I would say the disparity here is striking, and we have heard it come through in more nuanced ways in our discussions.
Okay, awesome. So let's stay on this topic. Being able to operate around the clock is increasingly important, and again, historically, Treasury operations have not been able to support that. Um, let's see here.
Yeah, we
So
see.
uh,
Yeah, please. Yeah,
yeah, so
sorry.
the survey asked what the barriers to 24/7 real-time settlement adoption were. Among those that found that important, these were the answers. So Sarah, I'm going to cut you off if you can. So just a quick question: why can't we move money faster, and what is required to overcome these barriers?
Yeah, we see here, I mean, I wanted to highlight here, we see really the barriers that prevent from doing real-time settlement and why we are not closing the gap today that we just saw at the previous slide. And the number one barrier is really, I mean, cited by 31% of respondents, is really the integration challenges when existing treasury or payment systems with the existing, let's say, legacy or treasury system. And that resonates strongly with what I hear from clients. A new settlement rate doesn't plug in independently. It has to connect to the TMS, to the ERP, the approval workflow, and the reconciliation engine as well.
Hmm.
Real-time settlement has to fit into existing workflows. It can't create a parallel process that the treasury team has to manage separately. And that's the first requirement on the right side of the slide. And it's really the precondition for everything else. So this aspect is really important. The second barrier we see here is really about the counterparty and settlement risk. And it's about 21%. And it speaks to, I mean, let's say to the controls dimension. And this is actually amplified when you move faster. When funds settle in real time, your window to catch an error, a duplicate, a fraudulent instruction is much smaller. So faster movement increases the importance of controls, and we see, for instance, in Europe, what we call the verification of pay with instant payment. The
Yeah.
infrastructure has to carry stronger safeguards precisely because the speed removes the traditional buffer that operations teams used to rely on. Third, we see here that 20% mention the fees related to the real-time settlement and bring the point that often gets overlooked in the technology discussion. Speed has to justify the economics. And not every payment needs to settle in real time. The business case has to be clear. Otherwise, treasury teams are paying a premium for a capability they don't systematically need, actually. And finally, here we see the transaction limitation at 17%, which is quite significant. And it's particularly relevant for large corporates. If a rail has volume caps or value thresholds, it simply can't serve as a primary infrastructure for organizations moving significant amounts. Limitations can outweigh the benefits for companies with large and complex payment flows. And that's exactly where adoption stalls.
Yeah.
Mm.
Yeah. Did you have another point? I don't want to cut you off.
No,
Oh,
that's why I
okay.
wanted. I mean,
Okay,
this
cool.
is really the key barriers
Yeah.
and why it's not moving faster, let's say.
Yeah. Yeah, so the results, here clearly point to the reasons there's such a gap in the previous slide, right? So, real-time settlement solutions will need to fit, seamlessly into existing workflows, align with the industry's risk profile, justify the transaction economics, and handle enterprise level payment volumes. But let's take a look at one of the emerging solutions for real-time settlement that everyone seems to be talking about. Definitely popular is a stablecoin as a settlement. So stablecoins have been gaining popularity as a payment rail, and for example, at the end of last year, the stablecoin payment volume doubled to 400 billion with a B. Joseph, can you walk us through the benefits and challenges around stablecoin solutions for 24/7 settlement?
Yeah, absolutely. And to your point, Rich, I think like the passing of the Genius Act is quite, helped quite a lot in terms of helping practitioners develop that level of comfort. But it's interesting, even even a few months ago, we did a separate survey on this. Many treasurers are still not familiar with the Genius Act. So it's kind of an indication that there's an opportunity there for for helping practitioners better understand stablecoin, tokenized deposits, and so on. I think overall, what's interesting, and we're not looking at the data here, but it does seem that many companies are taking a wait and see approach. And from our perspective, that's even more so the case for very, very large organizations. They want to see, more use cases. They want to see some of the regulatory aspects kind of develop a little bit further. But I would say there's a lot of interest in this. There's interest in adoption. But I think, again, the governance, the regulation, operational readiness, those all, it seemed like, need to come before implementation.
Yeah.
One of the biggest draws we touched on in the previous slide of stablecoin is, the near instant 24/7 settlement having potential to reduce float, improve cross-border payments, and lower working capital requirements. Those are real benefits that we're hearing members that are interested talk about, those that are already adopting stablecoins and those that are, right on the cusp. I would say where members and, where the people we're talking to are more cautious is on the operational side. So the technology might enable faster settlement, but, the treasurers still need to think about several factors, and we kind of talked a little bit about them just a moment ago. But
Yeah.
things like custody, reconciliation, reporting, and one of the biggest ones I would say is the moving funds back into traditional banking rails. So the
Mhm.
off and on ramp is something we hear constantly, and I think once a level of comfort that will occur smoothly. I think once practitioners get to that step, I think we'll see a large uptake in the use of stablecoins and other tokenized deposits. Um, so yeah, I mean, I think to kind of recap, what we're hearing is that before adoption becomes mainstream, practitioners want greater regulatory clarity, more accounting guidance, and they want to see more maturity around the integration, which was interesting. Cyril touched on that being the integration with existing systems being one of the top priorities. So no, yeah, I think it's the future, and we're right around the corner, but
Yeah.
there's still some steps before we get there.
So you mentioned a couple times in your comments about adoption. So are the benefits and adoption challenges of tokenized assets similar to that of stablecoins, or?
Yeah,
Yeah.
and I would love. Oh,
No,
I
no,
would
please, please.
say there's definitely a correlation there, but Cheryl, go ahead. I'd love to hear from you.
No, I was just thinking about what we discuss a lot indeed about tokenized assets. And for me, we see the same, let's say, adoption challenge as stablecoins. I mean, the wrapper is ready, the web portals are being prepared, but the underlying settlement still runs on traditional rails, as you mentioned.
Mm.
And the promise is real time, 24/7, with yield during the weekend. But we are in a transitional phase today. I mean, where the technology is ahead of the operational and regulatory infrastructure, and we are not there yet.
Yeah, I would echo the same as
Mm.
Joseph and Cyril here, where we're right on the precipice. The industry's building the technology, the infrastructure for that tokenized future,
Yep.
but clients aren't ready to dip a toe in yet.
Yep.
That readiness of the market, you think about something like ETFs 20 years ago, they were nascent then. I think that's where we'll be in the future with tokenized assets. One of the things we think will happen is the combination of the blockchain access and portal access might ease that friction while incrementally adding the settlement and operational ease. But we're seeing, as I think some folks had said here, large US companies are hesitant. We are seeing nimble fintechs and providers coming into stablecoins and tokenized assets, but there is so much room for education and handholding.
Sure.
And I think the distinction between stablecoins and tokenized money funds in particular is important. Stablecoins typically are positioned for that payment settlement instrument, not necessarily an investment product, whereas the tokenized money fund really is an investment product that's
Right.
represented on chain, but it can support a range of treasury and liquidity use cases for operating cash, liquidity management, payments, collateral management, stablecoin reserve management, treasury workflows. So we just really need folks to have time to kind
Yeah.
of adopt and get into here.
Yeah. Super great points.
Mm.
Super great points. Okay. Yeah. So this one, the survey posed a question about the value of a solution that would eliminate the trade-off or compromise between access to cash, payment capabilities, and yield discussed. So, as you can see, the vast majority of respondents found value in the ability to hold cash directly in T-bills while maintaining immediate liquidity for payment. So, it's not surprising as the solution addresses the priorities established by respondents in the survey. And this, call it 90%, right? Statistic highlights the desire for solutions that help bridge the gap between liquidity and yield while prioritizing safety. So, panel, any comments or commentary?
Yeah, I'll jump in here. I mean, I think this absolutely makes sense. Treasury teams are being asked to optimize capital efficiency, but not take on more risk. One theme that we keep hearing over and over is that, Treasury is being looked on to be a, value enabler and a strategic advisor. But, in terms of creating value for the organization, being able to, find a safe investment for yield and having less uninvested cash is, I think, one clear way where, the treasury team can create value. So makes
Yeah,
sense.
sure. Okay, cool. All right, so heading into the home stretch, and we're kind of on time here, so that's good. So just to recap what we went over today, geopolitical concerns, interest rate uncertainty, and banking sector stability are the top factors affecting cash strategy. Teams are responding by prioritizing access to cash, protecting principal, and minimizing risk exposures. The trade-off is a significant amount of idle cash, right? Meanwhile, there's a significant gap between 24/7 settlement importance and adoption. So what does this point to? There's a demand for real-time movement and optimizing cash management strategies for safety, yield, and 24/7 settlement. And this means, right, Caitlin kind of alluded to it, that the future is both exciting and challenging for treasurers. There's a clear need for a strong infrastructure to support today's treasurers' needs and challenges. And you can learn how by getting in touch with me or the panelist. And like I said, we're right on time here. So why don't we move over to the Q&A portion? And let's give that a second for the producers to feed me some questions. And I'm going to read these. So okay, we have one here. All right, Caitlin, why don't we start with you? How can treasury teams increase confidence in cash strategies for the year ahead?
Yeah, I think to me, this one is research, research, research. So challenge your investment policy, challenge your data. Is it deep enough? Is it wide enough? Challenge your assumptions. Is the lack of action due to friction really the best answer? Could the new tokenized stablecoin options be a way to get started and dip your toe in? And then I think the last in that research is think about the tools you're using and how they integrate with each other to be frictionless, or perhaps how they don't. So that to me is, I think, where, gaining confidence by knowledge is something that I think everybody can continually grow on.
Yeah, that's good advice. Okay, let's see. We have another one here. Cyril, if you wouldn't mind taking this one, what are some of the ways treasury teams are using crypto and/or stable coins?
Mm. Actually, we started, we see Treasury starting using stable coins, and they are not longer asking whether they should adopt digital rail, but they are asking how to do it without fragmenting their infrastructure. This is one of the points we mentioned before. At Kyriba, we've made a stablecoin powered, let's say, settlement, a native capability in our platform. Our clients can now route cross-border payments over on-chain rails, including through, let's say, a fiat to stablecoin to fiat model. So a ramping up, ramp down, settling in under an hour. Basically, blockchain is around something like 10 minutes, 24/7 in over 50 countries. And including corridors where correspondent banking simply doesn't cut it anymore. This is the main challenge we are solving with this option, and the treasurers are selecting this solution now. And critically, this run inside the same governed environment they already use for liquidity, fraud, cash reporting, no fragmentation, no new risk layer, just blockchain settlement with, let's say, enterprise-grade controls wrapped around it.
Great. All right, that's solid. Thank you. Joseph, why don't we get one more in? I think that's all we have for time. So for treasury teams that are interested in stablecoins and tokenization but aren't ready to adopt them yet, what are they doing or what can they do to prepare?
Um,
Don't
yeah,
make
no,
me on the spot.
that's a great question, and I actually loved Caitlin's answer, research, research, research. I think that's a key part of it, and I'm going to take that a step further and say benchmark, benchmark, benchmark. I think
Yeah,
talking to people that are doing it, talking to other practitioners, like getting together and learning from those that are taking the step, I think is super important. And I think, for Treasury and other finance leaders, the onus is kind of being put on them to educate the rest of the organization on stable coins. So, I think, research and benchmarking, I think that's the answer. So,
yeah. All right. I think that's good advice. Okay, so in terms of next steps, as I mentioned earlier, you'll receive a follow-up email with a confirmation of attendance for one CTP credit. We'll send you the full survey report as well as the slides. If you found this valuable, you can follow Jiko on socials and get in touch with our team by visiting jiko.com. And then I want to thank today's presenters, Cyril, Joseph, Caitlin, for sharing their insights. Thank you so much.
Thank you.
You can get in touch with these esteemed panelists or me via LinkedIn or the emails you see listed there. And again, thank you so much for joining today's session, and we hope to see you all very soon. Have a good day.
thank you.
Thanks.
Yes, fine.